All right, welcome to this explainer. Today, we are putting American public education, or APEI, through the ultimate analytical gauntlet. As an investment analyst, my goal is to strip away all the noise. Just look at the hard data using the most proven frameworks in the world of investing. If you've ever wondered how the true greats actually evaluate a business, well, you are in the right place. Let's get right into it.
So here is our game plan for today. First, a quick company snapshot. Then we'll view the stock through the legendary lenses of Warren Buffett, Peter Lynch, and Benjamin Graham, before finally running our own discounted cash flow and quantitative models to reach a final verdict.
Section 1, Company Snapshot. Let's set our baseline metrics.
Right now, APEI is trading around $52.01, giving it a market cap of $954 million. But here is the really interesting part. Look at that massive cash position. They are sitting on $221 million in cash against only $90 million in debt. That gives them some serious flexibility. Plus, they pulled in a trailing 12-month revenue of $659 million. So how are they actually making this money? Well, they operate primarily through their military and health segments, serving a whopping 106,000 students. And they're seeing some real momentum right now. Actually, they just reported an 11% year-over-year revenue jump, specifically in their health division. They've also been busy consolidating entities like APUS, Rasmussen, and Hondros into one unified platform. Definitely keep that consolidation in mind because it's going to be super important for our first Gurus test. Section 2, the Buffett lens. We are hunting for moats and margins here. Now, Warren Buffett wants a business he can easily understand, run by honest management, right? Looking at our checklist, APEI shows net margin expansion up to 5.4%. That's a huge jump from 2.9% a year earlier, proving they're actually efficiently converting that consolidated revenue into profit. We're also estimating a return on equity of 11.6% based on their Q1 equity of $306 million. Now, as for management, executive comp is 82% variable. Buffett usually loves that because it aligns management directly with us shareholders. But there is a bit of a catch. Management adjusted their bonus pool by $102,000 because of a federal shutdown. Honestly, Buffett might raise an eyebrow at that. He prefers managers who just take the bad with the good without, moving the goalposts. Still, glancing at their balance sheet, they've got $131 million in pure net cash. That is, cash above their debt. So they pass Buffett's test for a robust financial cushion with absolutely flying colors. Under this lens, this looks like a fundamentally sound business he'd likely buy, assuming a sufficient margin of safety.
Section 3, the Peter Lynch lens. Let's see if we've got a hidden gem on our hands.
Peter Lynch loves to categorize companies. So is APEI a classic turnaround story rebounding from restructuring, or are they a true fast grower? Given their crazy 137% spike in Q1 net income and their newly upgraded 2026 guidance expecting up to $2.68 in earnings per share, you could definitely argue they're transitioning right into a fast grower. Plus, they have that rock-solid balance sheet Lynch requires. But we really need to check out who actually owns the stock. And wow, okay, a massive red flag for Lynch pops up here. The stock is heavily dominated by institutional investors. Look at this. Divised Arrow, 325 Capital, BlackRock, they all own huge chunks. This completely breaks Lynch's golden rule of finding hidden gems that Wall Street has totally ignored. If the big players are already at the party, the easy money of discovery is probably gone. So for Lynch, this is a hold at best. Section 4, the Graham lens. Let's look for hard assets and undeniable value.
Benjamin Graham, the father of value investing, honestly couldn't care less about growth stories or management buzzwords. He wants earnings stability. He uses a super strict formula, the square root of 22.5 times earnings per share times book value per share. That 22.5 is just a constant he used to represent a PE of 15 and a price to book of 1.5.
Let's plug in our numbers. To get our book value per share, we take their $306.1 million in equity and divide it by their 18.4 million shares. That gives us exactly $16.63. Combine that with a trailing EPS of 196, and the math reveals a pretty stark reality. Graham's intrinsic value comes out to just $27.08. Seriously, meaning at the current $52 price tag, there is absolutely zero margin of safety here. Graham wouldn't even touch this stock. For a strict defensive investor, this is a clear-cut avoid because the market is just pricing in way too much future growth that isn't backed by tangible assets today. Section 5.
DCF and quantitative models. Time to project some future cash flows.
We can't only look backwards at historical assets, right? So let's build a discounted cash flow model. For our base assumptions, we'll take an annual free cash flow of $50 million, which comes from their strong Q1 operating cash minus standard CapEx. We'll discount that using a standard 10% weighted average cost of capital, or WACC, and apply a very conservative 2% terminal growth rate, essentially assuming they just grow with inflation forever.
Check out this sensitivity matrix. In our base case, 10% WACC and a 2% terminal growth, the fair value lands right around $55 per share. That means it's basically fairly valued today. Sure, if they execute perfectly and their cost of capital drops to 8%, that value shoots way up. But sticking to our conservative baseline, the market seems to have this one priced pretty efficiently.
Now, let's run a comparable multiple model. If we take their enterprise value of $823 million, so market cap plus debt minus cash, and divide it by their targeted 2026 EBITDA of $97.5 million, we get a multiple of just 8.4x. That is incredibly cheap. When you consider that industry peers often trade at 12 to 15 times EBITDA, APEI actually looks like a total bargain from an operating cash perspective.
Section 6. Synthesis and verdict. Let's bring it all together.
It's time to blend these conflicting signals. Our scorecard shows Graham running for the hills, since hard assets just don't support a $52 price. Lynch is hesitating because Wall Street institutions are already crowding the trade. But Buffett and our modern multiples, they tell a totally different story. They're signaling a strong underlying business generating massive amounts of cash, protected by a solid moat in military and health education. And our DCF model plants us right at a fair value of $55.
So ultimately, at $52.01, APE is a definitive hold for now, at least until Graham's criteria trigger a true value buy closer to $30. That being said, if you already own it, that crazy low 8.4x multiple means there is absolutely no reason to panic sell. But I'll leave the final call to you. Considering these totally conflicting views from the legends of investing, does APE's robust cash generation justify pulling the trigger for your portfolio today? Or is the lack of a true Graham margin of safety a total deal breaker? Thanks for joining me on this explainer, and keep testing those investments.